So recently, China has set lower growth targets. And it was, again, something that I found interesting. Many found surprising because we're used to China growing at a rate of, well, let's say north of 7%. For many years, they grew double digits, 9% growth. I think those times when were more when China was considered more of an emerging market. I know China still gets lumped in as part of the emerging markets, but I don't think of China as an emerging market any longer. China is the second largest economy in the world and growing quite a bit over the years. So when they say that they're going to grow at 5%, I know that both Canada and the US would love to have a 5% growth rate. But for China, it's a bit of a slowdown, a bit of a disappointment. So how does that affect the stock market? Well, it affects things such as oil, commodities in general, metals, because China is a very large importer of energy, of metals, materials, commodities in general. And so if the country is not growing as quickly as anticipated or as it once was, they don't need as much oil. They don't need as much energy. So what happens to the price of oil? Well, it falls. And very interesting, I've mentioned this on other shows before, when Russia invaded Ukraine, I believe it was Russia's intention, or what they thought was going to happen, was that the price of oil and natural gas would spike. And it did for a short period of time. But what they didn't anticipate was COVID and COVID lockdowns in China and COVID zero policies in China, because that's what has kept, in my opinion, the price of oil from rising significantly over the past few years. China policy, COVID over there, growth rates in China. They've had a tremendous impact on the price of oil. And because of oil being today roughly $75, $80 a barrel, instead of what many anticipated would be well over 100 by now, it's helped to keep inflation down. Yes, keep inflation down. Remember, inflation in Canada was over 8%. Inflation in the US was over 9%. Now inflation is 5.9 in Canada and 6.4 in the US. And in my opinion, a lot of that reduction in inflation has come because oil prices have dropped. The price we're paying at the pumps has gone down. Price of commodities, certain materials has come down. Lumber, natural gas is at multi-decade lows. We were fearful of a chaos in Europe based on natural gas prices. And what has happened? Nothing. So I think we have a chart. I think we had a chart on the China. Bring back that chart. And you can see how, if you compare China to previous years, you can see that other than 2020, where we had COVID hit, and 2022, when they had their zero COVID policy, you're looking at one of the slowest growth rates we've seen in a while. And what it's going to do is it's going to keep, or hopefully help keep, inflation in check, and hopefully help keep interest rates from really going sky high, which is good for us. But if you're someone investing in oil, in commodities, you have to be mindful of what's going on in China, because they are the biggest importer of those things, and they definitely affect the price of these things going forward, which will obviously affect the stock price of the companies that are in that sector.